Gold prices hovering around record highs with growing concerns about a slowing economy, maybe even a recession. Many investors are looking to gold as that traditional safe haven. We're navigating how to play the precious metal with the Yahoo Finance playbook. Joining us now, Chris Mancini, Associate Portfolio Manager of the Gabelli Gold Fund at Gabelli Funds. Thanks for being here, Chris.
Yeah, thanks.
And so in your world, you invest in gold through the gold miners. Correct. So talk to us about the value proposition of doing it that way versus gold itself and sort of how you think through which miners to look at.
Right, so what the gold miners give you is they give you income and they give you leverage to the price of gold. And they also give you growth. So what happens is a gold mining company, they generate revenue, they mine the gold, they have some costs, they generate free cash flow. With that free cash flow, they can either pay a dividend, buy back stock, or they can build another mine. So what you're getting with a gold mining company is gold, exposure to gold, plus that income and potentially the growth in the income.
Do you think gold is going to keep going up from here? And does gold have to keep going up in order for the prices of the miners to keep going up?
Well, that's a good question. I mean, I do think the price of gold is going to keep going up. I mean, that's a big, long discussion about, big macro issues. But I do think that things, by and large, are unsettled now with the tariffs and the trade war. The economy, like you said, is slowing. So I think that we might have some more monetary easing from the Fed, which I think would be good for gold. But in terms of whether or not the gold price needs to go up for the miners to do well, I think that we're at a point right now where the miners have really underperformed the gold price over the past 5 years or so, and they're generating lots of free cash flow. So I think that even if the gold price stays here, the miners have a really good chance of having a good run.
Yeah, Chris, I have a question because it seems a little bit different this time why gold keeps making new highs. It was always a refuge in times of uncertainty, inflation fears, all this sort of thing. But it seems to be very different this time, that there's real demand from the central banks.
Right.
So you could talk a little bit about that because it seems to have started when we put the kibosh on Russia's central bank and people said, oh, treasuries may not be so safe after all. And is that what you're seeing?
Yes, exactly. So right after Russia invaded Ukraine, Russia had around $500 billion of U.S. treasuries and also euro-denominated bonds. And when Russia invaded Ukraine, the U.S. and the European countries like Germany and France said we're essentially, we're not going to pay you back at the end of the day. So we borrowed money, the United States and European countries borrowed money from Russia. Russia gave us the money, we gave them the treasury bills, and we said to them, we're not paying you back. So we essentially confiscated their dollar reserves. And so lots of other countries now who have these big dollar and euro denominated reserves, mostly dollar reserves, woke up at that moment, especially China, and said, well, wait a second, wait, you guys have the option not to pay us back? Like, that doesn't sound so good. And so they are selling some of their dollars, some of their U.S. Treasury, dollar-based treasuries, and buying gold. Because gold, they can't, it's in a vault, it can't be.
And is that a genie that can be put back in the bottle? In other words, there's now talk about potentially having some kind of ceasefire or peace agreement between Russia and Ukraine. If sanctions are lifted on Russia, does that change that calculus?
I guess it depends on what's part of the deal. So if, as part of the deal, we say to them, okay, we're going to give you your treasuries back, maybe it does change the dynamic a little bit. But I don't think, first of all, I think that that's unlikely. And second of all, even if it does happen, I think China's sufficiently scared, and I think that other countries are sufficiently scared to say it might be prudent to put some in gold instead of dollars.
Well, the implications for this are pretty serious, it sounds like, particularly since we have such big needs coming up. And also, how does it tie into, and this is outside immediate investment opportunity, but even to our being the world's reserve currency, how do you see this long-term, the possible impacts?
I think that there are significant impacts. I mean, I think right now, if you buy anything or sell anything, if you're a foreign country, not a U.S. country, it all settles in dollars, and that's because where the U.S. dollar is the reserve currency of choice, or I guess of default. And so when you start seeing these cracks in the system, and countries perhaps saying, I don't want to use dollars anymore because I don't trust it. I don't trust that I'm going to be able to hold these, that they might get confiscated from me. The tariffs, I think, also play into that in terms of, okay, this country's placing huge tariffs on us. Maybe we don't want this to be the currency that we need to hold. When those cracks start to enter, then you start to look for alternatives. And I think that the primary alternative to that would be gold. because it doesn't have any of those issues of being able to be like needing to be paid back. Essentially, you own it. And it's, again, all for thousands of years, it's why it's been the currency of choice. So I think that's why we're starting to kind of see that maybe like the path of least resistance is gold going up from here.
And how do you see the supply of gold?
Barb, we have
Yeah.
to leave it here, actually.
Oh, darn.
Well,
This
we'll
is
have
so
you both back to
interesting.
continue this conversation. Chris, thank you so much for being here. Appreciate it. And Barb Doran, thank you so much for joining us for
Thank
the
you.
hour. Really appreciate it.